Hi everybody, my name is Greg McDaniel and this is James Callejas with Investment Property Exchange. Today we're going to be discussing a very interesting topic, something we've all heard, multiple different opinions about, and that's the fiscal cliff. James, can you help us understand a little bit more on what the fiscal cliff's effects are on people with real estate?
Well, the funny thing about the fiscal cliff is we didn't know when it was going to happen, and they waited really till the last second for the results. I mean, it was December 31st, and there was still no answer until the latter part of the day. And then we finally got some results of what's going to happen 2013 forward. So a couple of things that impacted real estate. On a capital long-term investment. So when you've held real estate more than 1 year and 1 day, it changes from short-term to long-term. What changed was the taxes that you're going to pay the federal government. Okay. It was 15% on your gain. That has changed, but only for a select group.
That's a short term, right?
No, this is long term.
This is long term.
So if you make more than $400,000 per year and you are single, you are now going to pay 20% instead of 15%. So everything up to 400 is 15. Everything above 400 is 20. Now most people think they're not going to be impacted by this, but it's not on your salary. It's your adjusted gross income, which basically means all sources of income, including the sale of this property. So when you're talking about a piece of property in California, many of those people don't make 400 as single, but when you include everything together, they will go over 400.
So if someone's making $150,000 a year in income, they sell a property and they make, $500,000. Now they're going to be paying 20% on anything above that 400 mark?
Yeah, so that first 250 will be at 15%, and the remainder of that gain will be at 20%, using those numbers, if they're single. If they're married, you'd think you get a big break, but it just goes from 400 to 450.
So it's not when you would have 250,000 for a single and then 500,000 as a couple.
Criteria: $400,000, $450,000. And once you hit those marks, then you're going to be 20 instead of 15. Everything up to that point is 15 on your gain. Everything above that is 20%. So that was the change in terms of the federal income tax. But you also got hit in the state of California. This isn't really fiscal cliff per se, but Proposition 30 came into effect, and that's the state tax. So if I've owned the real estate for over a year and I have gain and I look to sell that piece of property and I'm just cashing out, well, normally it would be 9.3%. Well, for a single person, once you hit $250,000, 250 to 300 is 10.3, 300 to 500 is 11.3, 500 to a million, 12.3, anything over a million, 13.3. So once you start hitting these different tiers, it's more of a blended rate. At the end of the day, it's more than 9.3%. So you have 9.3% that increased on the state side. You have the federal tax that increased from 15 to 20, and then you also have the Health Care Reform Act that came into fruition. Kind of fiscal cliff related, but not really because it came into effect prior to. That's an additional 3.8% you're going to be paying in capital gains tax.
So how much are you actually paying? It sounds like you're paying through the nose.
You could be. There's other ways to get around that, 1031 exchange, primary residence exclusion, but if you don't use one of those tax loopholes, you're subject to a significant increase in taxes. Now, also on the fiscal cliff, we had gift and estate tax. Well, how did that impact real estate? What most people don't realize is when you gift somebody real estate, you're gifting a basis.
So in a trust?
Well, not in the trust. Just if, however they hold title, they could be subject to gift tax. You are allowed to gift a certain dollar amount per year, and you have a lifetime exclusion. The amount you're allowed to gift per individual was increased this year from $13,000 last year to $14,000 this year. The amount you can give away in your lifetime was increased to $5,250,000. But if you give over that amount, or you give over the $14,000 and you don't put it towards your lifetime exclusion, 40% that the giver would pay. Gift tax and estate tax unified, both at $5,250,000. So if you give away, it impacts your estate tax. If you go over certain amounts, they're both at 40%. State tax, gift tax, federal tax, state tax for Proposition 30, the 3.8%. All these things put together, you hit certain criteria, you're going to be affected by them.
Now, your company, the Investment Property Exchange, can handle the vehicles to help folks save money.
On the investment properties, yes.
On investment
and on
properties.
ways to prepare ahead of time to not be impacted by these changes in terms of taxes, we can help and let them know what guidelines need to be met.
That couldn't be any more important if it tried. Ladies and gentlemen, again, this is James Callejas. As you understand and you just heard, he is incredibly knowledgeable about multiple different subjects. Contact us today. At the information on the screen, I'll put you in direct contact with James, and he would be happy to help you as much as he can. Again, my name is Greg McDaniel, and that was James Callejas.